You check your bank account. The number looks safe, stable, controlled. But what you don't see is what's happening behind it. Every dollar sitting there is quietly losing value. Every transaction is feeding a system designed to profit from your inactivity. And every year you trust your bank, you're falling further behind. Not by accident, by design. In the next few minutes, you're going to see exactly how banks really make money from you, why saving money is often the fastest way to stay broke, and what to do if you don't want to wake up 10 years from now wondering where it all went. Let me show you how it works. Meet Alex. He's 29, works a stable job, makes decent money, does everything right. He saves, he budgets, he keeps his money in the bank because that's what responsible people do. Right now, Alex has $25,000 in his savings account. He feels good about it, secure, disciplined, ahead of most people his age. But here's what Alex doesn't realize. That $25,000 isn't working for him. It's working for the bank. Here's the part no one explains. When you deposit money into a bank, it's no longer really yours in the way you think. Legally, you've loaned that money to the bank, and they don't just hold it. They use it aggressively. They take your $25,000 and lend it out. Mortgages, credit cards, business loans, often at 5%, 10%, even 20% interest. And what do they give you? 0.5%. Maybe 1% if you're lucky. That difference? That's the business model. Let's break it down. Your bank pays you 1% interest. Inflation is running at 3%, 5%, sometimes higher. That means every year, your money is shrinking in real terms. You're not saving. You're slowly losing purchasing power, quietly, invisibly. Meanwhile, the bank is using your money to generate returns far above that. They're earning. You're eroding. This is the first illusion, the illusion of safety, because nothing feels like it's happening, but everything is. Now let's go deeper. Banks don't just profit from your savings. They profit even more when you're in debt. Think about it. Credit cards, personal loans, overdraft fees. These aren't accidents. They're engineered systems. You swipe your card, you miss a payment. Interest kicks in. Suddenly, that $2,000 purchase becomes $2,600, $3,000, sometimes more. And here's the psychological trick. It doesn't feel like a big loss because it's stretched over time. Small payments, manageable, normal. But over years, you're transferring thousands, sometimes tens of thousands, directly to the bank.
Let me tell you about Daniel. Daniel had $8,000 in credit card debt. Minimum payments were about $160 a month. Didn't feel like much. He kept paying month after month. 3 years later, he had paid over $5,700 and still owed most of the original balance. That's not bad luck. That's design. Banks win when you keep your money idle, stay in manageable debt, and avoid asking deeper questions, because the system depends on predictability. If you store your money and borrow when needed, you become a perfect customer, reliable, profitable, controlled. Now here's where it gets uncomfortable. Banks don't actually want you to become financially independent because independence breaks the model. If you stop borrowing, if you start investing, if your money starts working for you instead of sitting still, you become less valuable to them. Think about the messaging you've been taught. Save your money, keep it in the bank, play it safe. Sounds responsible, but in reality, it's incomplete advice. Because saving without growth is just slow decline. Let's go back to Alex. He keeps his $25,000 in the bank for 5 years. Let's say inflation averages 4%. That means his money loses roughly 20% of its purchasing power. That's $5,000 gone. He didn't spend it. He didn't lose it in a bad investment. He just held it. Meanwhile, the bank used his money the entire time to generate profit. Now imagine a different path. Same Alex, same $25,000, but instead of letting it sit, he allocates it. some into assets, some into income-generating opportunities, some into skills that increase his earning power. Now his money is moving, compounding, working, and suddenly the equation changes. This is where most people get stuck because they think the choice is risk versus safety, but that's not the real trade-off. The real trade-off is visible risk versus invisible loss. Keeping money in the bank feels safe, but the loss is just hidden. Now let's talk control. Banks control access. They decide lending terms, they decide rates, they decide who qualifies. And when economic conditions shift, they tighten. Credit gets harder, loans get expensive, opportunities shrink. If your entire financial life depends on them, you're exposed. Ask yourself this: if your bank froze your account tomorrow, how long could you operate? If your answer is not long, you don't just use the system, you depend on it. This is the real risk, not market crashes, not volatility, dependency. Because when you depend on a system designed to profit from you, you're not in control. So what do you actually do? You don't need to escape banks completely, but you do need to change your role from passive participant to strategic player. First, stop treating your bank account as a wealth-building tool. It's not. It's a storage tool, a transaction layer. Use it for liquidity, not for growth. Second, understand the gap, the difference between what your money earns and what it could earn elsewhere. That gap is where your future is being decided. Third, reduce dependency. Build buffers outside the system, emergency funds, alternative income streams, assets that don't rely on constant approval. And finally, shift your mindset. Banks are not your enemy, but they are not your ally. They are businesses. Their goal is profit, not your financial freedom. Once you understand that, everything changes, because the goal was never to save money. The goal was to build control. And the moment your money starts working harder than the system working against you, you stop being the product and you start becoming the owner.